Good morning, everyone. Welcome to this update for global stocks and commodities for the 22nd of April. I've titled the video this week Marking Time because that's really what the markets are doing at the moment. It's very hard to pick the short-term direction. But look, it is what it is, and as you know my approach to the market, and that is that we be guided by the market action that's in front of us, not by any preconceived ideas about where we think the market should go or what it should do. So let's get in with it and get on with it and have a look at what the market is actually telling us. So in this particular update, I just want to reflect on why sentiment is so poor. I find it sort of comforting in a way, however, because when sentiment is as poor as it is at the moment, there is no way that this is a market top. We've just haven't reached the levels of exuberance or a general enthusiasm that would normally be associated with a market top. So I'm not actually concerned by the fact that the sentiment is poor. Um, it is just one of those things, and I think it's presenting buying opportunities, not necessarily tomorrow or this week, but in general terms, it is presenting buying opportunities. So I'm not concerned by it. It's really just a matter of how we negotiate the short term. I just want to have a look at how earnings season is progressing, and in a word, very well. And that's another reason why this is not going to be a serious downturn in the market. And of course, the normal update on stocks and commodity trends. And in Portfolio Analyst last week, as I indicated, I covered off a number of sector recommendations across exploration and production, across the oil services sector, and across also the downstream part of the energy chain with refiners. And I also introduced a stock that I must admit I had misunderstood their business for quite a number of years. I've been following them loosely for probably 3 or 4 years, and I had them pigeonholed as a certain sort of company. But when I really looked into it, the business model, there was a lot to like, and so I introduced that as a strong buy. Now, I just want to make the point just before we start that you've got to be careful not to associate the entire market with what the indices are doing. Now, at the moment, sentiment is poor. The indices are tracking sideways off the peaks that we saw in February, and it's easy to sort of think that the whole market is going the same way that the indices are, but quite frankly, there is enormous divergence. Some stocks are doing far worse than the index, and some stocks are doing far better. And they're the ones that we obviously want to try and zero in on. So don't get caught out just thinking about the indices. And I spent a lot of time going through sectors and industry groups. The database that I use has 210 American industry groups, and I've gone through and looked at the chart of every single one of those, and 29 of those 210 are meaningfully higher since the start of the February correction. So whilst the indices have gone down, there are 29 industry groups that have actually gone up quite significantly. And then, of course, within each of those industry groups, there is a great deal of variability amongst how the stocks are trading. So the task is not really to be trading according to what the indices are doing. The task is to find the strongest stocks in the strongest sectors, and have a good, robust game plan about how to get into them and how to manage risk once you are in them. So some of the strongest industry groups, just to highlight a few, aerospace and defence is very strong, and obviously good fundamentals around that. Application software, business services, and oil refiners are some of the strongest industry groups that are out there. And I'll just show you some charts of each of those once we've looked at the main indices, just to sort of ram that point home. You'll just see how starkly different the trends are. Now, looking at the American market in general, even though the index was down on Friday night, it ended up higher by 0.5% across the week, so it wasn't a bad performance. And earnings season is going well. There was just a little under 20% of stocks in the S&P 500 have reported, and 84% of those have beaten on profit estimates, and I think around 70% have beaten on revenue. And these are high numbers. 84% is the highest number that I can recall at this stage of the earnings season. So, that's really good, and the banks have all beaten expectations. So it's still early days. It'll be a very big week in this week coming for earnings reports, particularly Wednesday. There are literally hundreds of them coming out on Wednesday. But earnings season is going very well, and it's certainly supporting the market. It's supporting the valuations, and it's supporting the expectations of analysts. And if you look at the actual results at the moment, there's been an 18.3% growth in earnings or blended earnings. So that's just taking an average of the companies that have reported. And if that was to hold throughout the earnings season, then that would be the highest since 2011. So the growth rate is well and truly supporting the earnings per share, the PE ratio, because the PE ratio is sitting around 16, and to have earnings growing at 18.3% well and truly justifies that PE ratio. A couple of other aspects: the high margins that have been, the bears have been pointing to the high margins now for 2 or 3 years, saying they can't be sustained at this level because they're at a record level. Well, guess what? 2 to 3 years on, the margins are still being sustained at that level, and growth is still accelerating. So it's you're hard pressed to find negatives in this market, in my view, unless you've got blinkers on. Now, investor sentiment is poor. There's no question about that. There's surveys that give you the hard numbers on that, and there's no question that investor sentiment is poor. And there's also no question that fund manager exposure is relatively low. Fund managers are more cashed up than they would normally be. Now, these things are a real contrarian indicator. This is when you want to be looking at buying, when fund managers have got plenty of cash, and when investors haven't got all their money in the market, and they're not feeling too good about things. These are conditions that are closer to a market low. I'm not saying that we are at a market low, but they are closer to a market low than they are to a market top. That's for sure. That's the message. Another aspect too is that the advanced decline line and various other indicators of market breadth are still showing that the market breadth is still really strong, and we'll see that when we look at the Russell 2000. If there was anything more significant to be concerned about in the market, then the Russell 2000 would not be behaving as it is. The market would be getting held up by the FANG stocks and some of the other larger cap stocks, and all the rest underneath would all be, quietly crumbling. That is not the case at all. So that's another good sign. Now, the US dollar managed to work its way higher across the week. It's still within a contracting triangle, as we will see, but at least it's starting to sort of edge up a little bit, which is getting a little bit back towards where the fundamentals should be, because with the US interest rate cycle moving ahead faster than anywhere else around the world, the US dollar really should be going higher. Let's jump in and look at some charts now. We'll start with the S&P, and over the last couple of weeks I've been pointing to this particular little range here, saying that we needed to see resolution. I had a bit of a leaning to the upside, but I was probably closer to neutral than anything else. Well, early in the week, it did resolve to the upside. We got a jump out of that range that we'd formed, but then again you can see we came back on Thursday and Friday. Now, is this just come back to test the breakout of that range and the next move will be up? Or will this fail back into the range further? I have no idea, and I'm not particularly sweating on either direction. because my portfolio is set up to basically deal with either outcome. And it's really not what the market is doing, it's how you manage your portfolio when markets are in a very uncertain and indecisive time as they are at the moment. So I don't really mind what the market does, up or down. Doesn't make a lot of difference to me, and I'm reasonably neutral again at this point in time on the S&P. Let's look at the Nasdaq, the QQQ, and we had some fairly heavy selling in Apple on Friday night. Apple was down 4% on some fears about mobile phone sales, which just seem to come up every now and again. So that sort of helped drag the Nasdaq down. But we're still, it's a similar sort of pattern to what we saw in the S&P. We had a range here just above the 200-day moving average. We broke out of that range with a fair amount of force on Tuesday, and now that's failed back again. Let's look at the Russell 2000. There's IWM. We're not that far off the all-time highs. In fact, we're probably closer to the all-time highs than we are on the other indices. So a good sign for market breadth. Now, let me just point to, so with those index charts in mind, now let me show you what some of the strongest stocks look like. And these aren't recommendations by any stretch of the imagination. These are just the strongest stocks and the best trends within the strongest industry groups over the last 2 months. So what I did was to go through all of the industry groups and look for those groups that were comfortably higher than in February. So February happened here. So this is the start of the correction in February. So you can see we had 2 days down, 44, but now we're trading at 58. So that is in stark contrast to the index. Let's look at another one. This is a company called Moody's in the business services sector. February is here. So here's the February correction. We then went on to quickly form new highs, and we're still trading above the start of the February correction. Another company called Cognizant Technology, so it's a tech stock. February correction was here. The price is now up here, significantly better. And these are big companies. This company is roughly a $50 billion market cap company. So it's not like these are small caps. I've chosen large cap stocks. This is ConocoPhillips, one of the world's biggest energy companies. Here is the February correction, and here is the share price right now. So I think you're getting the point. ICF International, same story. We've actually got a very robust breakout over the last couple of months. And finally, this is Marathon Petroleum, which is a stock that I did review in Portfolio Analyst. February correction here, round about the mid $60 mark. We're now trading up at $80 and looking extremely positive. So my message here is, don't get caught up just because the indices are doing whatever it is they're doing. Don't get caught up and think that there aren't fabulous opportunities in the market, because there always are, no matter what else is going on. Turning now to Aussie stocks, the Aussie dollar fell a cent down to 76.7, and our index managed to gain another 0.7 for the week, so that's 0.7% gain back to back. The banks were weak, the miners were strong, energy was strong, and we'll look at those indices in just a minute. In fact, we'll look at them right now. Just before I go there, I'll just look at the US dollar. So here's the US dollar. We're still in this basing pattern down here. You can see we've got a converging triangle. It's really hard to pick which way this is going to go. Is it going to break out to the upside? The fundamentals would suggest that it should, but it could easily break out to the downside as well. Okay, let's now look at the ASX 200. So this is a weekly chart. So we dropped out of this triangle that had formed here between 5,800 and 6,000. We've had 2 weeks of rebounding, but look, it's anything but convincing. If you look at this is the materials index on a daily chart, so you can see it's been a very nice rebound in materials. But if you look at also energy has had a really strong week as well. But if you look at banking, that was the week last week, just down every single day. The banking sector was down, and they've got so many headwinds that they're facing at the moment. I'll just also show you a chart of Commonwealth Bank. This is on a weekly chart, and you can see that we're approaching critical support here at around 70, 71. If CBA breaks down from that level, then I think we're going to see a significant technical move in CBA, and I'm sure that'll drag the other banks down with them. And there is just so much poor press coming out of the Royal Commission that who knows. Just while I'm here, I'll look at precious metals. So silver made a very strong move up during the week on Wednesday. That came very much out of the blue. Gave back a little bit on Friday, but that was really currency effect as the US dollar strengthened. But that was quite a significant move for silver. And let's now look at gold on a weekly basis. So you can see we're still in this rising trend channel. We gave back a handful of dollars on gold during the week, but gold stocks are actually now starting to outperform, starting to look better, which is something that we haven't seen for some time. It's not really that evident in GDX, as you can see, which is the basket of all the major stocks. But again, if you zero in on some of the better performers, if you look at a stock like Newmont, for instance, which is the world's biggest or second biggest gold miner, you can see quite clearly we've got a series of higher highs and higher lows. We've got an upward sloping channel, and I can tell you that if this can break out above this 46.50 level, there are a lot of fund managers that will be forced to buy Newmont. And if gold breaks out above 1400, you're going to see a stampede into gold stocks because the fund managers they can't afford not to be there. Now that hasn't happened yet, and I'm not saying that it will, but that's something to keep an eye on. So precious metals, gold down by 8, but stocks are starting to lead, which is a better sign. If you want gold stock exposure, I can't find anything stronger anywhere around the world than right here at home. Our top gold producers are looking really good and have been exceptionally strong. And I don't include Newcrest in that. They've got some of their own problems, but I'm looking at the 4 or 5 stocks in the next tier down from Newcrest. Turning to other commodities, copper was higher to 315, which was a positive sign, and held the gains on Friday despite the fact that the US dollar went up. So copper was quite solid. Crude oil got up to 69.5 during the week, edged back a bit on Friday night with the stronger dollar, but still holding at 68.3, and it really does look on its way to $70 and beyond over time. So small pullback on Friday night, but again, energy stocks and in particular the drilling stocks looking pretty good. So let's just take a look at XLE. So there's the overall energy sector. So that includes everybody in the energy space. So this has been quite a solid breakout, which occurred about 10 days ago. And it's been a pretty good move. And you can see down the bottom here, this is showing the index relative to the S&P. You can see very significant outperformance since the 21st of March, so nearly 4 weeks now. And this is what the institutions look for. They look for the sectors that are outperforming. And so money flowing into the energy sector tends to become a self-sustaining spiral to the upwards. And as long as they sustain that outperformance relative to the S&P, then they're going to continue to get more and more money flow from the market. There's the spot copper chart. So we continue to work our way higher off the $3 support level. And there's crude oil on a 3-monthly chart. You can see just how strong it's been since early April. So a really positive move there. So to wrap it all up, look, there's really no change from last week. For longer term investors, I see this as a really good time to be accumulating. I wouldn't be doing a lot, and I would only be buying on your terms, but it's a good time for accumulation. Traders, shorter term time horizon, still a time to be cautious, I believe. I can't say with any confidence that we won't see some more downside in the short term. So traders, just be cautious. My overwhelming advice is have some sort of method of identifying what the strongest stocks are, whether it's research you do yourself or whether it's research that you pay for from someone else. Then that's what you should do, because the variation in performance between even the average performance and the best performance is absolutely dramatic, as I showed you with those other charts. Portfolio analyst this week, I'm going to be doing a sector review, looking at industry groups, identifying where all the strength is, with a view to to doing just that. The other thing that I also want to review is Apple. Now, Apple got smacked around a little bit on Friday night, down 4%. We've seen this movie over and over and over again over the last, pretty much constantly since Steve Jobs died. People want to try and put Apple in the trash can, and it goes through this cycle from being in favour to out of favour. And so I'll be examining the question whether Apple is still a buy. There's my contact details and website for anyone that wants to communicate with me who's not a member. And I'll be back with you next week. Cheers.